Matt Freund, you say it's not a bond market, but a market of bonds. We hear that a lot for stocks. What does it mean for fixed income?
Well, you're right. We do hear it for stocks all the time. At USAA, we think you have to apply that same discipline to the fixed income market. So everybody thinks of the bond market as treasuries. There's only one rate, only one market. We look at it very holistically. High yield bonds, corporate bonds, structured product, tax-free bonds. There's a whole range to choose from.
So if you like spread product, there's not a lot of yield out there, and you're finding it in that spread product, what type of sector do you like right now, especially when it comes to corporates?
Okay, so within, you're right. So spreads have compressed a little bit, but so have defaults. And on a risk-adjusted basis, we still think you're being well compensated in parts of the market. So we do like corporate credits. The weaker BBB space, you have to be careful on your credit and the names you pick, but we think that makes sense. High quality, high yield makes sense, and then some asset backs, specifically commercial mortgage-backed securities and double ETCs.
And you also like muni bonds. There's a lot of credit quality worries there when it comes to places like Detroit and Puerto Rico. Are you buying some 8% Puerto Ricos?
So there are some headlines there, and it is amazing how Puerto Rico was really left for dead just a couple months ago and has since come back very strong. We think there's great opportunity, though. When you think about munis, the headlines can be bad. Taxes are going up, services are going down, but credit quality is getting better. And so if you're selective, we think munis make sense.
So over the rest of the year, will we finally see rates rise? We got a good jobs number for February. We had better than expected retail sales. If the economy does improve, we get 3% or more GDP. Will Janet Yellen let these rates rise? And what does that mean for your portfolio?
So 3% GDP, I think, is a stretch. But we do think there's a good chance that we do see a weather rebound. Now, I don't know if it's going to be as strong as everybody expects, but I do think rates will gradually grind higher. But remember, the key is not are they going up. We think 5 years from now, 10 years from now, they're going to be much higher than they are today, but it's the speed, and we think they're going to go up slower than the market expects.
All right. Thanks a lot, Matt.
Thank you. Great pleasure.
Thank you for watching The Street.